This is a discussion about the accounting concept of revenue. We're going to have this discussion in the context of a trading business, and a trading business is one where stock is purchased from suppliers, which is then resold to customers. And we'll use the example clean cut mowers. Clean cut mowers trades in ride-on mowers. They buy the ride-on mowers from suppliers and then they sell these mowers to their customers. So it's selling the mowers, which is the business's revenue activity. Sales is the business's revenue activity. Have a look at this profit and loss statement. You can see that over the course of the reporting period, which is July 2018, the business has generated sales of $20,000. A good general definition or explanation of revenue is the earnings of the business. Revenue is the earnings of the business. It is sales that works to promote the increase in business profits. Sales is the activity that helps the business increase its profits. In this example, the $20,000 worth of sales has helped the business generate the profit of $9,100. Net profit belongs to the owner and works to increase owner's equity. And this is demonstrated by the balance sheet extract, where net profit is added to the owner's equity section in the balance sheet. The $9,100 is added to the owner's equity section. So sales of $20,000 for the reporting period has helped contribute to the profit of $9,100. We know the profit belongs to the owner and works to increase owner's equity as demonstrated by the balance sheet extract showing add net profit $9,100. Let's have a look at a simple definition of revenue. Transactions that lead to an increase in owner's equity excluding capital contribution. We'll look at an example of one transaction and see how it fits into this definition. The example we're going to use is cash sales of stock $8,000. The business sells stock, receives $8,000 from its customers. In this example, we're going to exclude the effects of GST and the cost of sales. So cash sales of stock $8,000. This will increase assets by $8,000 because it'll lead to an increase in cash or bank. And it'll also lead to an increase in owner's equity because the sales activity increases owner's equity. So, does it fit within the definition? Transactions that lead to an increase in owner's equity excluding capital contribution. Yes, the transaction has led to an increase in owner's equity, and it's not a capital contribution, so it must meet the definition of revenue. Here is a more comprehensive definition of revenue. An increase in an asset or a decrease in a liability that leads to an increase in owner's equity excluding capital contribution. Same example, cash sales of stock $8,000. The business has sold stock for cash to its customers and received $8,000 cash. There's an increase in an asset, $8,000. That's part of the definition. An increase in an asset. Assets have gone up, $8,000. And there's also an increase in owner's equity due to this sales activity. So it does meet the definition of revenue, the full definition of revenue. An increase in an asset or a decrease in a liability, that part of it's irrelevant to this particular transaction, that leads to an increase in owner's equity. It's not a capital contribution. So this transaction, cash sales of stock, $8,000, that part of it certainly meets the definition of revenue. Let's now test the definition of revenue with a variety of transactions and to see whether or not these transactions fit within the definition. Example number 1 will be borrowing $3,000 from the ANZ Bank. Come back and see the next video.